Hello and welcome to Investing Confidential. It is Monday, April 7th. The markets did not collapse. This was not Black Monday like Jim Cramer and some of the other morons out there were talking about. Obviously, the situation is not good, but I mean, come on. This isn't. I mean, I mean, I was a young kid working at Merrill Lynch when the market was down 24% in one day. We've had what, a 20% correction in a few weeks um, in a lot of companies. Okay, terrible, but not the worst. Not Black Monday. But look, this again, as I told you, I think these tariff things are a complete sideshow, and I'm going to explain why. I'm also going to give you a reason why Wall Street is gone. Um, when I say Wall Street, I mean the what's holding together this thing of this fighting against the government, and more importantly, this the trying to prop up financial assets at any cost, lying, the cheating, the pushing of globalism, the degrading of the American worker. This is all Wall Street, folks. And I'm going to show you why Wall Street, I'm going to tell you right at the end of this video, Wall Street is dead. Okay. And that's one thing you don't have to worry about going forward, which is a positive, by the way. Wall Street being wounded, let's just say not that. Wounded is a big positive, and I'm going to show you why. But listen, let's just jump right into it. This is the reason that everything is a mess. Okay. This is the live debt. If you don't have this, take the URL down. The U.S. debt clock. We're at 36 point, almost 36.7 trillion. In a few weeks, well, we'll be at 37 trillion. It's not stopping, folks. It's just not stopping. There's also some interesting information there. There's a Doge clock, shows you how much Doge is cutting, how much savings per taxpayer. It's actually pretty interesting. But the bottom line is that it's not slowing down. Okay, despite Doge, despite everything else, as I go back to the continued comment that November election was a turning point. It didn't matter who got elected. It's Trump, it doesn't matter. Neither one of them is addressing this, and this is why we are having these issues. Trump's trying to a certain extent, but it remains to be seen. But at least he's trying. Kamala Harris and the Democrats wouldn't even try. We'd be in deep doo-doo. Maybe not this kind of deep doo-doo in the short term, but it would be even a bigger disaster. So no one's addressing the debt. But let's look at the damage that's being done and whether it's, big damage or not. But first thing I'm going to show you is probably why the markets are going to bounce. Look at this put volume. I would say this is, going back, we'd have to go back 15 to 17 years to see put volume at these levels. What does that tell me? Everyone's buying puts. People are capitulating. Market's going to bounce. Short term only, but we're probably going to get a bounce here because of this. But look, the bottom line is, again, when we look at the betting markets, okay, what the betting markets are telling us is that the chance of recession are even greater than we thought. It's 70% now. Again, these betting markets are much more accurate than the U.S. government numbers, which are a complete joke. So I don't care what the current administration is saying on television. We're in a look, folks. We've been in a recession for years. I've told you that before. This is just numbers, the meaningless numbers, meaning two consecutive quarters of negative GDP. For the average U.S. worker and consumer, we've been in a recession for 4 years. End of story. So don't be surprised at anything. And look, all these pundits are all talking about the Fed. The Fed's going to help. Wall Street's factoring in 2 rate cuts. Look, folks, we've already had a rate cut. Okay, the 10-year is below 4%. 2 years, everything is going down because it's what we're seeing, folks, is deflation, beginning of deflation. So rates are going to come down naturally. The Fed is irrelevant. we're probably going to have a stagflation situation because inflation is going to probably start propping up towards a little over 3%. But that's, again, you can't focus on that. You have to focus on what's really going on. Deflation. Okay, first we're seeing deflation, which is, a lot of people said, I heard Scaramucci telling, oh, deflation is terrible. Look, deflation normally is really bad, but the US needs deflation. We had a massive monetary inflation spike in 2022 because of the last administration's deciding to follow the Ben Bernanke dumbass rule of helicopter money, and just in 2021 just literally dropped almost $6 trillion of cash onto the US, literally from helicopters. Read about Ben Bernanke and helicopter money. This is what they did, and it caused a massive inflation spike. And you can't celebrate because inflation was, what, 8%, and now it's 2%. Because that doesn't help you, folks. The rate of inflation is still growing. You need deflation to get a lot of these prices down. And what we're seeing today is deflation in financial assets, which is a good thing. The stock market was out of control. Real estate, the most overvalued ever, unaffordable by everyone. You need deflation in these financial assets. You're having, it's and the only place you're making money is bonds, by the way, and that's something that all these strategists say, don't buy bonds. Well, that's where you're making money, the bond market. You're not making money. You're not going to make money in the stock market anytime soon. I don't care whether it rallies, short-term rally, whatever. Stocks, bonds, real estate are financial assets. You're not going to make a lot of money. You'll probably be better off in bonds right now, but financial assets are doomed, folks. And they've had a long run. So, don't cry for anybody. So, as I said, the rate cut has already happened. There's nothing. The Fed's going to do nothing. There's no Fed cut. There's no Fed put. Excuse me. There's nothing the Fed can do. So the results of all this are obviously pretty severe. Why we're going to continue to see this 70% recession in the numbers, because here we have, consumer sentiment is down. It has to be down. Okay, every day in the media there are layoffs. You got tariffs are going to cause massive inflation spikes. The car companies won't be able to sell. All this fear mongering. Okay, it's not real reality, but the fear mongering causing consumer sentiment to literally drop off a cliff. That is going to exacerbate this negative GDP, which we're going to have. But again, as I told you, for the average American, we've already been in a recession. This is a Wall Street recession, folks, by the way, which is a good thing. Okay, and then to me, the biggest danger is you have CapEx. This is really bad because if companies don't spend, that means they won't hire. That means they won't do it, and it's just going to make the recession longer. Okay, if this continues, this more than even consumer confidence, if this continues, the Wall Street recession will continue, and it's going to affect everybody. And we're already seeing the effects. I mean, here we go. This is Americans falling behind in car payments. Folks, we're all-time high. Think about this. We're supposedly in a great economy in the last couple of years, 2020, 2024, and delinquencies are rising rapidly. Now they're really risen. So this is obviously very bad. But there's also some positive effects that's going to happen. Here we have income inequality, excuse me. The chart, I apologize for the size of these charts. They're just tough to really, but let me see if I can make them a little easier to see. If you look at here we go. Let's do this. I'm going to do this live. If you look at here, the top chart, which shows the top 10% of earners, XX savings. Okay, look what they've earned. Because again, this is because of stocks and real estate. 1.3 trillion versus the bottom 90% only making 290 billion. That's all Americans. This is bad. Okay, now we look at the share of spending, right? Who's spending? Okay, the money's who's spending? Who's driving the economy right now? Who's driving the economy? It's it's the Wall Street, top 10% of earners. They're at 50% of overall spending. You know, and this is not now if you're spending that money and all of a sudden your stocks are dropping, your real estate's going down, you're going to spend? No. And the lowest 20% of earners don't do anything. So this this um this Wall Street recession is going to have a big impact, continued impact. It means it's going to drag this thing out longer. But on the other side of the coin, this wealth gap is going to start to shrink, which is a good thing. Okay, always trying to find something good. But folks, you know, the whole tariff thing is kind of funny with all the comments, because what these pundits are, they're actually, when you hear them talk, they're actually against America. They're saying, oh, this is terrible, this is affecting our partners, or this and that, they consume. And they're worried about Europe. They're worried about China. They're not talking about the positive effects on America. Potentially, right? I'm not going to be partisan here. This is all potential. I don't think I think the way these tariffs have been marketed, whatever you want to call it, is terrible. Terrible. Did we need some of these things to happen? 100%. I mean, the facts are that all of these European countries have not allowed American companies to sell. They use a lot of excuses. They don't allow. Same with all these other countries. They don't allow U.S. goods. They don't allow it. And so, why not? For the first time, we got somebody standing up for America. Now, the way they're doing it, implementing it, I think is ridiculous. But and it's dangerous, by the way. And I give them credit only because they have a very, very small window, right? We have midterm elections happening in 2026. They're crushing the economy, which is the smart thing to do if you think you have a plan to get it back up again. Because you really only have, after you crash the economy, you got 6 to 9 months to get it back up again, and that's tough, because midterm elections are happening in 2026, and if the economy stays where it is today and goes lower, which they want it to go lower, and doesn't recover, Democrats are taking over the House. They'll probably take the Senate, and Trump will be impeached, and everything is going to be gone. Okay? Or back to normal. Let's just put it that way. So, but look, what's going overseas is worse. Okay? I think Trump knows, and the people at power believe they have negotiating power, and they do, because here, China is toast. China's been in deflation for quite some time. Their economy, folks, is destroyed. We have the leverage over them. We're not selling anything to the Chinese consumer because the Chinese consumer has no buying power. Relatively speaking, the deficit with China is mammoth, meaning what we buy from them, what they sell, and what we sell to them. It's mammoth, absolutely mammoth. And the Chinese economy is in deflation, continues still. So we have all the leverage. Okay, and what's China? Look, and what's happening? Oh, the Chinese currency, as you see here, it's devaluing. That's their only hope. They're going to have to continue to devalue it, but that's a double-edged sword, because when you devalue a currency like this, it's going to be problems, big inflationary problems. But remember, China's a command economy. But this is not good. China. Bottom line is, folks, China is in no position to mess with us on the trade front. Absolutely no position. Okay. Then you got Japan, which is going to negotiate, but they've got problems too. Look at their government bond, the JGBs, spiking. Okay, this isn't, technically it could be good for Japan, but not really. But they're coming to the negotiating table. And Europe, forget about you. This is corporate bankruptcies in France. So is this a strong economy? I'll answer the question. Absolutely not. Absolutely not. Two biggest economies in Europe are France and Germany. So as you see here, France is in a pickle. Do they have bargaining power against Trump? Absolutely not. And Germany, even worse. Look at the unemployment rate in Germany. It's going through the roof. It's back to COVID levels. Okay, we all talked about COVID levels. Not good. And industrial production, negative. So German economy is in recession. It's been a recession for quite some time. Their stock market's been going up, but now it's reversed. Unemployment's through the roof. Do the Germans have retaliatory power to bargain? Well, not to bargain, but to go against the U.S. in a trade war? Absolutely not. Nothing. They can't do anything. So in the short term, the current administration holds all the cards. But as you can see here, and I apologize for this thing here. Let me move it back. Folks, the result of all this, no matter how you slice it, is even if they bargain with us, they're not going to be bringing their money back anytime soon, and their ergo, the US dollar, is weakening. And as I spoke before, again, another positive for the minute, they need a weak currency as a way to offset large debts. This is, again, an IMF playbook. I don't think anyone in the administration was that smart, but sometimes it's better to be lucky than smart. So let's talk about Wall Street, because Wall Street is the guys behind a lot of this globalization, right? That has really caused the beginning of this whole tariff thing. All of the movement overseas, China going WTO, all promoted by Wall Street. Okay, and Wall Street's got problems, folks. This is before the pandemic. First of all, M&A activity, because of the uncertainty, has gone to zero. This IPOs, which 2025, Wall Street was betting on a massive IPO calendar year to basically bring money back into their coffers. They've been losing money for quite some time. They bury it in accounting numbers. But here, we saw this before the pandemic. Big, IPO, boom, sank 10%. So it failed. And then, as you see here, all-time low in IPOs. All-time low. I mean, this was supposed to be a banner year. It's not going to happen. This is very negative for the Wall Street people, and I don't see it rebounding anytime soon. This is a disaster. 2025, 12 IPOs. Are you kidding me? So the result of that is this, folks. You got Goldman Sachs telling its people, you either move to Dallas or Salt Lake City or you're fired. Or you're fired. That's simple. So New York City, the financial capital of the world, is no longer, I think I've said this before, I'll say it again, the three big financial cities of the anchor for the financial markets, Hong Kong, London, New York, they're all gone. Hong Kong is gone. China, Brexit destroyed London, and this sinking of Wall Street and the movement out of the cities, or out of the expensive cities like New York, it's over. Okay, absolutely over. And you can see it in the big numbers here. The red is Wall Street hiring. The blue is firing. The last few years, we've had massive amounts of firing, literally no hiring. The Wall Street business model is dead or dying. And in a situation like this, where you've got financial markets reeling, banks pulling back, normally Wall Street would step in and do some. They're not in a position. Not in a position. And folks, that's a good thing, by the way. I mean, These people are not, they served a purpose. They don't serve any purposes anymore except to harm you, especially with the rolling out of these private credit and all these things, which I want to do another video on. This is another complete scam and a Ponzi scheme that's being set upon investors. So once again, here's your debt clock. It went up since this little speech. Probably went up, I don't know, 100 billion. It just keeps going up. It's going up. 36.7. It's going to be 30, 37 by the end of the year. Probably pushing 38 trillion. No chance of it stopping anytime soon. Because the powers that be don't want to do what's right. They don't want to cut. That you see how many people fighting Doge. Like, why would you not want to cut expenses in the government? Now, the media is, hyping all this. They're firing all these government workers. All this play. Look, if you no matter where Doge cut, you're going to have people complaining. End of story. So there's nothing you could do. There's nothing you could do. So my question is, how do we get to this 30, almost 37 trillion? If the government was running correctly, how did we get to this? Okay, did we get to it because Joe Biden in 2021 helicoptered 5 to 6 trillion? Did we get there because in 2020, because of the pandemic, Trump, authorized 2 trillion in payments out to the American people? Yeah, absolutely. Did we get there because we spent, I don't know how many, 5 or 6 trillion during the Afghanistan, Iraq debacle, only to leave it in worse condition than it was? And by the way, yes. So all of these things compound to the and this is the result. So do we want status quo or do we want change? The change happening now potentially be positive, but it's really rough. So there's no, magic elixir that's going to fix this. In the short term, everyone's bearish, so we're going to get a bounce. But in the medium term, as the numbers start to show in the real numbers, the numbers that don't matter anyway, but that we are in a recession, look. But remember, the deflations at Wall Street, the financial assets, is good for Main Street. Prices will come down in housing. That's the most important thing. We focus on what is important. The American dream, owning a home. You're going to see that. You're going to see that. And you need deflation in all the prices of goods. You need to. What do you want? Okay, things were up 8-9%. Now they're only up 2%. They never go down? No. You need these to go down. Normally deflation's terrible, and if it lasts a long time like it does in China, it is terrible. Because that combines with a real estate collapse, business failings, whatever. But look, it's a business cycle. We have to have business cycles, folks. Wall Street doesn't want to have business cycles. You need business cycles. You need up and you need down. We need a down. We haven't had a down in quite some time in the economy. So, I don't know. Will it rally the next couple days? Probably in the short term. But it's not good. Okay, the tariffs not being handled correctly, causing a lot of chaos, a lot of companies pulling back, uncertainty. Bad for Wall Street, which is good for Main Street. But in the end, in the short term, it's going to be a lot of pain. So all investors, unless you're in money market funds and fixed income, be careful out there.